Welcome to the Northeast Shadow MPC with Clive Owen LLP, Recognition PR and the Northern Echo. In this session, we regularly talk to business leaders from different sectors about what their business outlook is like and how they think the real Bank of England Monetary Policy Committee should act on the issue of interest rates. Even with the devaluation of money slowing considerably since the start of the year, inflation is proving stubborn at 6.7%. But the UK PLC's debts are at the highest they've ever been, certainly for decades and decades, and now they're more than the entire equivalent of GDP. New experimental estimates last week showed that the slight rise in unemployment was prevalent, but the Office of National Statistics warned that these estimates should be treated with caution, since they were for the first time derived from tax records and benefit claims rather than the labour force survey on which its figures are traditionally based. So now it's time to see how the ship is being steadied and what the consequences of the previous rate rises are by talking to a number of our members of the Shadow MPC. Not everyone's on the video today. We've had some of the decisions about rates emailed in to us from people like Katrina Lingwood and John Young, but we'll get to that when we get to the rate vote at the end of our discussion. So let's start with Paul Gibson. Paul's from Active Chartered Financial Planners. Now, Paul, you've heard me introduce some of the headlines, the rate of inflation and unemployment, which was marginally up, but not necessarily taken as a given. What about other economic indicators, and what are you seeing in the marketplace?
Well, it's we're certainly starting to hit the tougher times now, I think, particularly in financial advice. We're seeing probably getting on for 2 years now of no returns in investment portfolios. Cash has certainly been king, albeit it hasn't kept pace with inflation. And we're starting to see people come off fixed rate mortgages. So this seems to be the start of potentially where we're going to be going over the coming months.
Now, of course, you look after investors, don't you, Paul? So it's interesting. The investors are probably very happy at these interest rates. They're getting some significant deals on the market.
Yeah, particularly cash rate savers and investors, they're okay from that side. But anyone with a traditional investment portfolio has not really seen a return since the end of 2021. So it has been extremely challenging times simply with a huge increase in interest rates. So yeah, you mentioned 6.7% for CPI. RPI is still just short of 9%, albeit it has come down from 13.8 in February this year. So inflation's starting to come back a little bit, but it's certainly not coming back nowhere near as much. And it's a bit laughable that we're going to try and get down to 2%. I just can't see how we're going to get figures down to those sort of levels.
I suppose that higher interest rates have an issue for people you advise because they may be normally investing their funds in the markets.
Yeah.
The markets are depressed because of the higher interest rates. And that affects returns. But also, if markets are depressed and people aren't investing, there's less money to invest. You know, some of these funds that are using investors' money to put into new businesses or to put into investing in growing businesses, those funds are a little bit shorter. A little bit less
They are,
money.
yes. Certainly this year we've seen people come in and the discussion's been around, where's my short to medium term investment strategy? Do I stay in cash? Do I dip my toe into the markets? Do I start to invest? And for the first time, probably since the dot-com bubble at the turn of the century, we're now seeing people where cash has a place for investment. And people are starting to say, well, let's put a bit into cash and let's put probably 75% into the investment portfolio. I think the outlook long term, as we hopefully are nearing the peak of the interest rate cycle, this is potentially a really good time to invest and get into those markets. So as inflation hopefully continues to fall and they get somewhere around the same level of interest rates, that's a really good indicator that we might start to see some returns where the appetite for risk might come back because interest rates will start to fall off.
I noticed that the big national savings investment, the peak rate, has just come down a bit. It's still more than 6%. You can still get more than 6% putting it with the government and you know it's safe.
It's safe, yeah, exactly right. And again, even in a lot of the top banks, we have access to cash platforms. You know, certainly you can get a lot of instant access, anything up to 1 and 2 years, all still starting with fives. So, you know, you're looking at a potential investment portfolio that traditionally did 7 to 9% on a medium risk with risk. versus getting 5-6% with no fees and no risk. So it's certainly becoming more of a challenge. However, saying that, if you look at the 10-year gilt yield, that's now starting to fall. We're now to about 4.5% as of this morning. So the indicator is interest rates over the long term won't stay as high as they are today.
One other point on general economic projection, I checked the oil price on Friday, and despite the turbulence in the Middle East at the moment, it went up a fraction and then came down a fraction. It hasn't really changed other than a small fall in the last few weeks.
That's right, yeah. I mean, Brent crude, I've got my figures here. Brent crude on the 1st of November 21, when markets at the peak was $83, and at the time of me preparing this information, it was $88. So it's not moved too much in over that time period. It's certainly not been as volatile as interest rates, inflation, or investment markets.
Very helpful, Paul. Man with the figures. That's what we like from Paul. Now, let's look at some other people with figures. Let's go to Martin Pullen next. Martin, you deal with FRP, and it's a recovery business, so it sometimes closes businesses as well, but maybe tries to trade them out of difficulties. FRP advisory. What are you seeing? Is business brisk as a result of the current economy?
Yeah, it still is a challenging time. I mean, inflation it feels like we've dealt with the easy part of the inflation figures, and now we've got the tough part to come. I think in terms of what we're seeing within FRP, we've seen a rise in businesses seeking our support in terms of the restructuring side. We've seen deal activity fall slightly in terms of the corporate finance side. And our forensics division that often gets involved when there are challenges within business and there's fallouts that often come with those challenges, they are busy at the moment. In terms of the kind of national figures, we are, I think, insolvencies in September were sort of 17% up on where they were in 2022. However, 17%. That's still not quite the levels.
17%. That's quite 17%. A significant figure. That is a big number.
It is year on year. Although you've got to think that I think we're still in the realms of coming out of COVID. There were lots of initiatives and lots of additional borrowing that suppressed the normal levels of business distress that we might otherwise have seen. So as much as we're 17% up year on year, 22 to 23, we're still not quite at the 2019 levels, which was, a typical, not hugely growing economy, but a growing economy with challenges within the business world. And as we know, some businesses just don't quite make it. So we're not quite back to the real world there. But in terms of personal insolvencies, they've actually fallen quite significantly. And that may be because there was a spike last year and maybe, people have had their fresh start and there's not as much of that to happen at the moment.
Dare I venture to sort of suggest to you that what you've just said, if I summarize it with a short phrase, we've potentially hit the bottom?
Yeah, I would say so. The challenge at the moment, the businesses that I'm seeing that are really struggling are those that are involved with any discretionary spending. So anything that's consumer related is challenged at the moment. So everything from home improvement, some retail, etc., has got a challenge. And I think there's a lot of kind of holding a breath of what will this Christmas be like, which we know for many seasonal businesses rely on the Christmas trade being fairly brisk. Construction, some areas of construction are still doing very well. But anything involved in house building with the challenges in the market and sort of construction and house building has fallen generally. That sector's struggling. That's one of the... it's always in the sector top 3 of the sectors with the highest levels of insolvency constructions there. And I think that's largely down to the contractual nature of those businesses and, the disputes that happen as a consequence of that. It's not quite as linear as some, manufacturing businesses, etc. But yeah, certainly discretionary spend, construction, and sort of the service sector, I think that's still feeling a bit of pain from the kind of the pinch on household expenditure, which I think from the data I saw reading the FT and other publications seems to have been easing a little bit, but those sort of the savings that households generated during the course of COVID, those appear to have, those aren't there anymore, and households are now kind of living a little bit more hand to mouth, and that is a challenge. And businesses that rely on consumer spending are seeing that.
Martin, thank you. Great analysis. Let's move to Nicola. We co-sponsor this with Nicola at Clive Owen LLP. You have a large basket of clients in all sorts of different sectors where you do the audit and you do advisory work. Do just give us a little bit of a dipstick, what you're seeing, what's the temperature check of those clients?
I think there seems to have started to be a slight decline in that business confidence, where we haven't been saying that in previous quarters when we've been having these meetings. Clients are complaining more about interest rates, because the other side of the coin to what Paul was saying, of course, is that a lot of our clients borrow a lot of money, and they're seeing those numbers coming through now on the bank statements, or when they're looking at the management accounts, they're seeing that huge increase now. So they're hoping that interest rates will be close to the peak. I'm sure of that. Clients are also anticipating over the next 12 months an increase in costs, an increase in salaries, and this is all what's affecting this business confidence, or this decline in it. Concerned the corporation tax rises that I've mentioned before, they changed from 19% went to 25% in March. So clients with year ends finishing after March are now seeing like a hybrid rate. They're seeing corporation tax going up, and there's some quite big numbers in there. The clients do still seem busy. They've got plenty of work on, but the profit margins are being eroded by all these things. So that means they're not intending to spend as much on capital equipment going forward. And whilst they still want to invest in people, there's less of that capital spend. And I did just see some figures from ICAW, our Institute of Chartered Accountants, last week, and they were commenting that companies in the northeast are the least optimistic in the country. Other parts of the country much more optimistic. And the other comment they made was that there's plans for our northeast companies to reduce R&D spend, so they're going to be treading water a little bit more.
That's interesting. I mean, the Chamber of Commerce survey said exactly the opposite last week, so
really?
we slightly take them with a pinch of salt, but the accountants maybe have more access to the books.
They were. This was them asking accountants. So perhaps accountants are naturally pessimistic.
Well, yes,
I'm not sure.
I mean, you go on the battlefield and you bane at the wounded sometimes. We love you. We love you nevertheless. No, so Nicola, I think you've given us a little bit gloomy, but nevertheless, your realistic picture is that trade is okay, but costs are diminishing the opportunities for decent returns from that trade.
That's right, and stopping some investment as well, which is important, isn't it?
And the interesting thing, I suppose, about this is that is what the interest rate policy is supposed to do, and people forget that, don't they? And it's a bit of a negative. Everyone thinks, oh well, you know, inflation's coming down, but if the gas isn't off the interest rates, then the benefits won't actually come through, will they?
No, it's a difficult one. It's a balance. We know that. That's what we've been trying to do all the way.
Let's go to David then. Now, David's in a consumer business in that the advertisements sold through NewsQuest, the Northern Echo, and all the other newspapers that are owned in the north of England, and the digital platforms are aimed at consumers. What are you seeing, David?
Yeah, I mean, our business is split. So we have a B2B side of the business in the advertising market, and we have a B2C consumer business with the information that we provide to readers and users of our website. We're feeling, quietly confident. Things have been pretty good this year, pretty stable revenue performance. We launched a new B2B brand, Local IQ, 3 or 4 years ago now, and that's going gangbusters. I mean, it's we're really delighted with the progress we've made there. As part of the Local IQ portfolio of services, we offer agency style digital media marketing services, and the DMS side of the business has just taken off. We're seeing phenomenal growth on DMS, and our digital advertising markets are doing pretty well as well. So next year, we're just looking at our annual budget plans at the moment, and we are confidently predicting that over 50% of our total advertising revenues next year will come from digital advertising. On the B2C side, interesting development for us has been on the subscriptions, digital subscriptions that we're starting to see coming through. We added a paywall to the Northern Echo's website probably 4 or 5 years ago, and it's been a very slow, gradual build. But that business model of charging subscribers for content through websites is now actually starting to work and pay off. and approximately, I'd say about 15% of our total subscription audience or paying audience is now coming through the website, as well as the print newspapers. So, yeah,
Well, that sounds
quietly
like
confident.
it's a positive thing. I mean, the newspapers really took it in 2008 with the recession then, and during the COVID pandemic, you were relied on even more. People did read you more, so it was an interesting change in what was happening, and what you're explaining now is a positive thing. I'm on the Shadow MPC as well as the owner of a business as well as chairing it. My own take is that we've had a difficult summer, but inquiries are up. And I'm seeing people starting, and my business is a business to business business, and I'm starting to see businesses saying, right, well, we think interest rates have broadly peaked. We've now got to work out what we're doing with our budgets. We're not very happy that costs have gone up, but we're still in business, and we've got to market ourselves. We're PR, you're digital marketing and so on. And I'm starting to see inquiries increase. I think that your business, my business, are probably at the front end of the economy. And if it was going down, we'd see it first. And if it's going up, we'd see it first. I don't know if you agree with that.
Yeah, I do. I guess we are. I say we're quietly confident because we don't want to overdo it. We're conscious of the fact. I think it was one of the earlier speakers. Was it Paul? I think it was Paul mentioned that there's still a lot of people to get to their interest rate renewal with their mortgages.
Mm-hmm.
And so a lot of people haven't really felt the impact of the mortgage rate increases yet. And therefore, that could be difficult next year. But overall, yeah, pretty confident about next year.
Well, that's good. I would describe myself as cautiously confident rather than quietly confident. Let's go to the last speaker today, who is Tim Bailey. Tim, you run Excite Architecture. You're doing design for building and so on. What's your own market like at the moment? You're at a long lead, aren't you? You're right at the front end of the economy. You have to have a lot of confidence to be investing.
That is true because of the long vapor trail that follows through planning, tender stages and onto site. So I think I'm not going to be able to go upside too much or downside too much today. And in fact, probably reflect other commentary already. Martin talked about construction being marginal and therefore offering, a top 3 place in the business distresses. I think that's borne out by activity that we've seen in the region earlier in the year with about half a dozen household names, you might call them, at regional level disappearing, which is very sad. The sort of background to that, I think, is many things, including cost rises, and the contractual nature of construction means that cost rise that happens inside a contract period of maybe of 12 or 24 months can't be recovered. So there's all sorts of issues relating to that. But the upside is that in the region, as of now, there's about £1 billion worth of work starting. Sounds like a lot of money. That actually isn't quite at the levels of 2 or 3 years ago, but it does indicate that not everything is falling off a cliff. So quiet, confident investment, particularly in the public sector, is good. Private sector, very much more cautious and related to performance at planning and in the financial markets. And so I think the sort of headline risk that is most talked about in the construction industry at the moment relates to global conflicts and effects that will have on costs and prices of materials, fuel and the like in the coming 12 months. So we're not operating on short time scales, and so it's very difficult to predict. That tends to lead, particularly at this time of year when we're running into Christmas, tends to lead to a lack of decision making, where people will ride out the last 2 months of the year and make decisions in January, February, when perhaps the 2024 predictions becoming clearer. So
okay,
that doesn't help much.
Okay, well, that's great. Thank you, Tim. And I know when we vote, you're going to have 2 votes because you're going to vote for Katrina Lingwood, who's been in touch with you. She's in charge of Constructing Excellence, the industry group. I have John Young from AV Dawson, who's deputy chairman. He's not on the call today, but he's emailed in his remarks, which is he's going to want to hold in base rates. He says AV Dawson, which operates ports in Middlesbrough, is seeing an evidence of downturn activity with some major customers, and any further rate increases, he says, could exacerbate this beyond the period that they've got at the moment. So he's going to be voting for a hold. My vote will be for a hold. I think the bank has done what it needs to do to tackle inflation, and more increasing further now would not necessarily do anything but damage. I think very soon there'll be an argument for a cut, but I would go for a hold. Around the room, let's see what David Coates says. Hold, raise, or cut?
Yeah, I'd vote to hold. I echo those comments. Whilst we feel quietly confident, we feel very quiet about it.
All right, fair enough.
Vote to hold.
Let's go to Nicola Bellaby. Hold, vote,
Yeah,
hold.
hold as
You're
well.
a hold?
Yeah,
okay.
definitely hold.
Paul, you might go. You sometimes you've got a bit of different sight of the economy to everyone else. You want to raise or hold or cut?
I'm going to go for hold simply because we don't know how much pain the current rate's going to give. It takes so long for data to come through, and I think we've seen that through 2023. So I think let's hold. We've raised them high enough. The pain is still coming.
I'm going to challenge you because you have a lot of the economy under your watchful eye. The bank didn't actually see inflation come down last month. The 6.7 was the same as 2 months ago. So maybe it does need to just tweak it. Just keep the lid on.
There's such a gap in the timing of data, though, isn't there? I think we keep up the rate, but the data's months behind. So I think it will hit, and I think particularly mortgage rates more than anything. People coming off fixed rates at the moment, they are staggered at how much their mortgages are going up.
Good point, well made. Thank you, Martin Pullen.
Yeah, I think I would vote for a hold. I think the expectation broadly is that in the US and in Europe, we're going to see rates broadly at this rate for some time to come. Unfortunately, our inflation hasn't come down as quickly as those sectors, but as those economies. But yeah, I would go for hold.
Tim, you got 2 votes because you're being a proxy for somebody else as well. What are your 2 votes? I
am. Interestingly, they're all the same. Hold on this side because it's already been articulated. There's not enough evidence to suggest a rate change one way or the other. And hold from Constructing Excellence as well, based on regional information and the word on the street.
Okay, so the vote is for hold. Hands for hold. There we are. Thank you very much. That's it for this month's edition of the Shadow MPC. You can see a write-up of this in the Northern Echo and on their website. Thanks to Clive Owen for helping us sponsor it and all our participants.